I know you've been digesting all the news out of China and how that has whipsawed markets. What do you think a day later when you've got oil prices back to 79? That's obviously OPEC getting involved, but does it also indicate that the market is thinking the shutdown in China might not be quite as serious as we thought yesterday at this time?
Yeah, I think, all these cross currents are causing, especially commodity prices, to move quite a bit. But longer term, look, I think when China comes back on, demand is going to start rising, and that's going to put pressure on commodities on the upside. And I think we need to watch that. And nobody really knows what's going on in China. So when you look at that and you look at what's going on in the world, we're trying to do, when I say we, the Fed is trying to do demand destruction. And along with that comes pricing coming down of commodities, which is one of the biggest inputs of inflation. So I think China by itself, if it starts coming back, you're going to see some upward pressure on commodity prices. At the same time, the dollar is going to start moving as well because the dollar has been so strong. So I do think going forward, one needs to watch commodities, and I think there's still a play when you invest, whether it's in oil and gas or copper or aluminum, because I do think the demand there is not going away.
That's really interesting. Jeff Curry was on Worldwide Exchange this morning, and he had a similar thesis. He was saying, look, you might see oil, WTI, under some pressure right now. The reason you're seeing energy stocks hang in there is because of just that. People know that China is likely to come back in the second quarter and come back on strong, and that is going to drive those prices up, and all of those stocks are trading on the forward expectations. Does that mean you're making plays in some of these energy names, or what do you do?
Yeah, so we've got a good exposure to energy. We're not really selling it. If we're overexposed, we would. I would definitely add some energy exposure on a pullback. I also think it's interesting to look at some of the copper names, such as Freeport. I think, what you're looking at here in the classic commodity cycle is a supply-driven issue. We don't have enough supply if demand picks up, and that just puts huge pressure on prices on the upward side. So I do think it's a place to play. Now, having said that, Becky, these are very volatile stocks. These are very volatile earnings going into kind of a slowdown globally. So the investor really needs to be careful. This is one of those things you put as part of a diversified portfolio. You don't say, hey, I'm going to go all in over here, because if things do slow down or we get some really bad news, commodities are kind of one of the first things that will represent a huge slowdown. So I advocate as part of a diversified portfolio, but I don't think you need to go all in here.
What else makes up that diversified portfolio? I know you liked healthcare for a while.
We do, and I'll tell you why, because I think when you look forward, estimates really haven't come down for the S&P. We're still staying, around 220, and I think that's going to come down. So you want to own areas, sector stocks that have low volatility of earnings, and healthcare fits one of those. I mean, companies like Glaxo trades at 10 times earnings, Bristol Myers 10 times earnings, J&J even at 15. These companies, we have a better see-through for the next 2 to 6 quarters in terms of earnings. They're rising. They've got strong balance sheets. They've got dividends that are growing. I think, again, part of a portfolio that is defensive, but you can actually play offense with healthcare at these points. You can play offense with consumer staples. Again, the beta, the volatility of the earnings is going to be a lot less than some of the other sectors. So if earnings are coming down, these companies are not going to come down as much. Also, in a play of the U.S. dollar, as the dollar gets weaker, these are multinational companies. They're going to benefit from a weaker dollar. So a combination of having healthcare, staples, diversified portfolio, I think will really help. Doesn't necessarily mean you have to stay away from the high beta names. You can still own some of those, but I think for the next 2 to 6 quarters, these are going to be some areas that will actually return some positive returns for the investor, as opposed to kind of just saying, hey, I don't want to lose money.
So, right, you've talked about financials being a good place, but I'm guessing you're selective if you have to worry about a potential recession and potential bad debts.
Yeah, I think one has to be careful there. I mean, there's some companies like a Morgan Stanley that are still trading at 10 times with, huge wealth management business. A couple of them that we like that have really been beaten up, Silicon Valley Bank, that has this negative halo effect with crypto. We don't think that that's really going to be a huge issue for them. They're back to trading around 12 times earnings. It's one of the premier banks out there. So I still like it. They're going to make a lot of money in deposits. I think credit is going to be important. But all the banks going through this have been very careful with credit. So we're not going to have that issue. People still are jaded by the financial crisis. So, I like the Bank of America's, the Morgan Stanley's there, Silicon Valley, First Republic. I think, you've got good dividends, good balance sheets. But those are actually more beta plays because people think, earnings are going to still come down there, but they all trade at, 2/3 the multiple of the S&P. So you'll get value there, but a lot more volatility, higher beta than some of the other sectors. But again, we have it as a part of the portfolio, and we think it's important to have it going forward.
Thanks, Sarat.